It's been a volatile week for the Nasdaq 100, with the US CPI print plus a bunch of central bank announcements from the Fed, the ECB, and the Bank of England this week. I mentioned in the last video about 11,480 being the first level of support to watch, and we held that overnight on Sunday when markets opened. Monday's move was driven by a handful of names, with Microsoft's announcement on taking a 4% stake in the London Stock Exchange as part of a 10-year deal where the exchange will migrate to using the cloud. Now, Microsoft said it expects revenue of around $5 billion to be generated from the deal, so that boosted sentiment. Then came the main events. US CPI, which came in below estimates at 7.1% when 7.3% was expected. Core inflation was also down to 6% from 6.3%. Immediately, stocks jumped and the Nasdaq 100 touched the 200-day exponential moving average around 12,225. However, price snapped back and closed below the 200-day. That's a bad sign for bulls. If a miss in inflation numbers, which the market has been obsessed about all year, cannot breach key levels like the 200-day, it suggests upside potential is capped. And sure enough, price came off the following day, as Fed Chair Powell reiterated the need to continue with the rate hiking cycle until inflation is on a sustained path downward. Price did hold on to the 40-day until Thursday, when the selling began to accelerate. We had the Bank of England follow the Fed in raising rates by 50 basis points. Then the ECB followed, also raising rates by 50 basis points, but warning that the central bank sees significant increases in rates and will begin to shrink the balance sheet. Here's a look at a chart which shows the ECB balance sheet and the main base rate. You can see the two are likely to converge and meet as the balance sheet comes down and rates rise. Here's a similar picture of the Fed funds rate and the Fed balance sheet. Here is another chart. This is a comparison of the Fed funds rate and the 2-year yield. The Fed funds rate has never been higher than the 2-year yield. It has equaled the 2-year but never been higher than the 2-year, with data going back 22 years. Now, with the 50 basis point rate hike by the Fed on Wednesday, this takes rates to being in line with the 2-year. Now, either the 2-year moves higher from here, in which case expect more downside from stocks, or we are done with rate hikes. You can see from this chart the reaction of the 2-year versus the Nasdaq 100. The inverse correlation between the 2-year yield and the Nasdaq 100. First, the miss in CPI, yields drop, Nasdaq 100 spikes. Then on the Fed announcement, yields spike and Nasdaq 100 falls. So if the 2-year continues to move higher, believing Powell that further rate rises are on the cards, then this will be a negative for stocks. Back to the daily chart, Thursday's break of 11,480 support was also driven by weak economic data, with US retail sales missing estimates. Recession fear continues to be priced in. In terms of levels to watch into next week, we can see here price holding the 11,180 support level for now, followed by this short-term trend at 11,120. Below that, and it's on to 10,925. On the upside, 11,480, which price broke below, will now act as resistance. Above that, and the 20 and 40-day moving averages will act as further resistance around 11,600 and 11,620. It is very likely after this week's reversal from the 200-day that we are now setting up for the next leg down. Do trade cautiously over the holiday period with volume lighter than normal. There can be abnormal moves in either direction. With that said, thanks for watching and your support for the channel. Do remember to hit that subscribe button so you don't miss out on future content. And I'll see you in the new year.